DP sir, can we start?
We are ready.
Yes, please.
Okay. So, good evening, everyone. Thank you very much for joining in for this session of Nivesh ki Baat. It's a very special, talk that we are going to have today. Of course, we have with us, our top management team. We have Mr. DP Singh, our Deputy Managing Director and Chief Business Officer with us. We also have Rajiv Radhakrishnan, who is the CIO Debt. And we also have with us our senior fund manager, our go-to man for all our duration strategies, Mr. Dinesh Ahuja. So before I hand it over to DP sir, just wanted to, set the context of this call. So we are living in such an interesting time that, the way in which India is being looked at by the outsider, it is changing. What we have seen is that people are looking at us with eagerness. They are looking at our economy, the way in which we are behaving, what we are doing. They are looking at our markets with greater interest like never before. Just to put things in perspective, if we really look at three different areas of our economy, if we look at, say, our equity markets, we look at our debt markets, and we look at our currency markets, and then compare how we have done in last couple of years, which were very, very trying times for all of us. What we see is that our equity markets have fallen the least when you compare yourself with, say, US equity markets or European equity markets. Your currency has fallen the least when you compare yourself with economies like UK, Germany, Japan, and even the way in which the interest rates have gone up in developed economies, we have fared very, very well. In fact, India is called as the oasis of hope in this global arena. So I think these are very, very interesting times wherein we believe that today it is very, very important for our distributors to start positioning debt funds to their investors. When we really look at the composition of debt AUM in our industry, we find that retail investors have not participated adequately in that. And I'm sure, all the three gentlemen who are there who are going to address you, they will talk about the importance of positioning debt funds in the times when we see that, the bank deposit market is at about 180 lakh crores and mutual fund is today at about 38 lakh crores. So there is a huge opportunity which lies for us to sell debt funds to our investors. So I think this session is going to be focused only on debt funds and the opportunities which are there, in the debt side of our business. So without much ado, I'll hand it over to Mr. DP Singh, our Deputy Managing Director and Chief Business Officer. Over to you, sir.
Thank you very much, Sandeep, and welcome everybody on this special talk on debt funds. We are talking about debt funds today because we feel there's a whole lot of opportunities which is available for all of us in our business. It's available for us in the mutual fund industry. It's available for the distributors for intermediating and getting funds from the investors in the debt category. As Sandeep said, we are a 38 lakh crore industry today, out of which around 16, 17 lakh crores or 18 lakh crores rather are into equity assets. The remaining 20 lakh crores are into debt assets. And when we further get down, out of this 20 lakh crores, almost 14 lakh crores are without intermediation. So the intermediated money, including the institutional money, is 5 lakh crores. And if we talk about the individual's money into the debt funds, through intermediation is hardly 3 lakh crores against the bank deposit of 1,80,000 crore. I will not put it as 1,80,000 crore because even if I take out around 30,000 crore of institutional money, the 1,50,000 crore against that, the money which is there in the debt funds is 3 lakh crores. So this is something which throws a whole lot of opportunity. We all know that debt funds are akin to the bank deposits, with the only difference that here we value our our securities on daily basis, whereas in bank deposits it is not being done. But the yields where we are today, the kind of opportunities which are available, the kind of capital gains which we can make for our investors are huge. I think this 3 lakh crore money can be, if educated properly, narrated properly to our clients, there's an opportunity of collecting almost 15 to 20 lakh crores in the next 2 years. This is the kind of money, because all evolved money, the big ticket business which is lying today in the bank deposits and the fixed deposits, can be brought into our business. We as manufacturers and you as intermediaries, because we are not B2C, we are B2B or B2B2C. We are here to manufacture product for you, which you can always take it to your clients, keeping in view their risk appetite. If they are very sure about the tenure for which they are making, that they are putting money, the new innovation of targeted maturity fund is one of the best. When we talk about the bank deposits, you generally hear the word that there's a net interest margin of 3% to 4%, 3.5%. That is the difference between the money which they borrow from the customers and at the rate which they lend to the banks, lend to the customers, right? But in our case, this difference on an average is 70 basis point to 100 basis point in the long term, and the shorter terms it is 10 to 20 basis point or 30 basis point, or some cases it is 30 to. So the range is between 30 basis point to 100 basis points. That alpha of 2% which is available, if you keep aside the mark to market, can be given to your investors by properly distributing and taking these funds. That's why we are very convinced that this is 3 lakh 4 lakh crore market can definitely be 20 lakh crore, and we can make it happen together. For that, what is required is how we position our funds, for which our experts are there. But I will tell you, today we have funds which are available for 1 day money to 10 years money, which is there. 1 day money, 3 days money, 7 days money, 15 days money, 3 months money. And the target maturity funds are so good that if you are putting, say, for 5 year target maturity fund, and you need to withdraw after 2 years, 2.5 years, 3 years, or after 3 years, you will not only have the tax efficiency after 3 years, but there is an opportunity that you can make a very good capital gain. So that's where it is. The only thing which I feel is the pain point is the margins which are available in the debt funds. The margins for the distribution, the margins for the fund houses together. Yes, the margins are little less, but as a good, prudent businessman, we have to learn to understand that there has to be a good mix of fee difference between the manufacturer and distributor, and we need to sell low margin products along with high margin products with the big volumes. Today, if my AUM as a distributor is 100 crores, it can be easily be 200 crores by narrating this thing, but by the additional 100 crore may not get me 1%, may not get me 1.2%, may get me 60 basis point, but overall, my overall absolute number will go very high. But this is something which is very important, very necessary, because our competition is not with one fund with another fund. Our competition in fund house is with the deposit which is being put on the fixed coupon products, and there's good number of people who can get into the mark to market products. So this is the basic pretext. What, in addition to what Sandeep said, absolutely right words given by Sandeep. We are here to help you to educate the distributors as well as to the investors. We are here to work with you hand in hand, and we are here to tell you how we are basically positioning our funds so that we get more and more money from the investors side, and we become a bank branch in my area. If I am a distributor, I should see that should, as a unit, should be a bank branch of a thing. And if people should come walk in and come to me as a distributor to say this is my surplus money, how to manage it. So that's the way we foresee the future in India, and we foresee that 3 lakh crore, 4 lakh crores to 20 lakh crores in next 2 years. And I think there's enough money to be made for all of us. So with these words, I hand it over to you. We'll have the question answer session, but before that, I hand over to Rajiv. Rajiv, over to you. You can give the you will give you all the inputs on the what is the where is the opportunities, how well we can make it. Okay, I'll request you to come here. That people can see what is wrong. Thank you very much. Thanks. Let's start.
Yeah. Thank you, DP sir. So good afternoon, everyone. What I will do is I'll try to keep it very simple. We've got a few slides that basically give some perspective on where we are in the debt markets, where we think it goes, and as DP sir was saying about why at this point in time there is an opportunity to re-engage with fixed income funds. I know that in the last couple of years, given the way the interest rates in the system had gone down, a lot of investors didn't find too much of appeal investing in fixed income schemes. But again, there are economic cycles, and in the last cycle, for sure, given the impact of the pandemic, there were extraordinary monetary and fiscal, or in India's case, it's largely an extraordinary amount of monetary stimulus that was provided, which of course led to a significant drop in market yields. And then over a period of time, we have seen how the yields have actually corrected. So if you can just I just need to scroll down, right? So, any discussion on Indian fixed income markets today will broadly be incomplete before if you don't see the context under which we are operating, and to a large extent, what is happening in the external world does impact our markets as well. So, what I mean before I go ahead, just for the convenience of our guests, what we've done is we've put in a mix of English as well as a translation of some of those key points in each slide into Hindi. At any point, you can, I mean, maybe over or the Q&A session, we will try to engage in Hindi, but pardon me, for the time being in the presentations, I will stick to my talk in English. But very clearly, we've tried to capture the essence of each of these discussion points by a translation in Hindi. So, coming to this context, what we have seen is over the last maybe 6 to 8 months, we have seen a significant amount of monetary policy tightening. And this has been, unlike earlier cycles, more or less synchronized across the world. In this case, the biggest change has been the amount of tightening which has been done by developed market central banks, especially the Fed, because Fed, in a way, the actions of the US Fed have a lot of ripple effects across markets and across various jurisdictions. So it's very, very essential to understand the context under which these policy actions have been done. So what has been the change? So if you go back maybe a year back, most of the central banks used to consider the surge in inflation as transitory. So inflation was expected to fall back over a period of time. So at that point in time, not much of action was done on the monetary policy side because the growth situation was in focus, or rather, the priority was once you had COVID, you had to essentially support the financial system, and then over a period of time, you have to enable growth impulses to pick up. So clearly, the focus was on maintaining growth. Inflation was considered to be transitory. But what has happened, if you look at the graph on the left hand side, this is a summary of how global inflation has evolved over the last, I think we've got about 10 years of history or so. Over the last 1 year, 1.5 years, we've seen a significant surge in global inflation, global CPI moving almost close to 9%. And why this happened is you had a large amount of monetary and more importantly fiscal stimulus which was given in the immediate aftermath of COVID. Now that was required at that point to enable the financial system to be protected, or rather to prevent a collapse in the financial system, and eventually it had a lot of impact on real economy as well. But stimulus was withdrawn, or rather not withdrawn at the right point in time. Over a period, you did have growth coming back as the COVID receded, and the amount of stimulus which was provided in a very short span of time. So if you look at data, I mean, the central banks just doubled their balance sheets in a very short. The key central banks like the Fed and the ECB would have doubled their balance sheets in that phase. So you had a large amount of fiscal monetary stimulus given at the same time, which wasn't withdrawn at the right point in time. You had growth picking up. Initially, you had supply bottlenecks. Unfortunately, you had a geopolitical issue as well. But what has happened is inflation has remained persistent at an elevated level for a long period of time. And once that happens, you have the risk of that getting translated into wages, and then you have that typical wage price spiral. So to an extent, the reaction of central banks, which you see in the right-hand side, which is the chart, it basically shows how they have responded to the surge in inflation. And so this is under which we are operating. So go to the second. Now, as I said earlier, actions of the Fed matter a lot given the interconnectedness of the markets and the way capital flows across jurisdictions. So, now what is really happening over the last few months? Now, we had a meeting of the FOMC a couple of days back. All of you are aware what the Fed did. But more than what they did, the market had certain expectations. So, what was the expectation? The market was expecting that the Fed will turn out to be slightly dovish in their guidance, or in the sense that markets were looking at the Fed providing you guidance that going forward, the rate cycle will pause or at least downshift. So now what has happened over the last 4 meetings is they have done 75 basis hike in every policy meeting, which effectively has resulted in the Fed funds rate or the interest rate moving from 0 to 4% today. And we have seen how the market yields have also gone up accordingly. Now, this chart basically shows how the market's expectation of future Fed action. So effectively, at various points in time where the market was expecting the peak rate of the Fed funds rate to be. So if you look at this over a period of time, what has happened is as the Fed has increased interest rate, has provided guidance which is considered hawkish or actually slightly hawkish than market's expectation, the market expectations continue to shift upwards. So now this slide has not been updated after the last meeting. Today, the market is expecting that by middle of next year, I think by May, the Fed funds rate will go up to some 5.20. So, and that's the amount of additional rate expectations which are built in based upon market expectations. So what is happening is the market is looking at the Fed pivoting or becoming dovish, but they have turned out to be hawkish and the rate expectations have shifted. Fine. Yeah. Okay. Sorry. Yeah. So this is the broader context. The market has been searching for this, what I characterize as the elusive pivot, but the pivot has not really happened. And because of that, the expectations get pushed up, bond yields go up further. That creates a lot more of volatility in the asset market. So this is a broader global context where we are at this point in time. Now, if you go forward now, more relevant to what is happening in India. Now, as Sandeep mentioned earlier, and DP sir also did talk about how fixed income markets here are getting to a point where levels are reasonably attractive. So now if you look at this particular table, it basically shows how our market yields and policy rates have moved. Now, if you look at the first column, that is where our market rates were by end of 2020. If you recollect, that's a time when you had a lot of stimulus provided, interest rates were cut down to 4%, liquidity was infused in a massive amount into the system. Now, what is essential to note is the first column and the highlighted column, which is the last one. To what extent have yields moved in India over the last, say, if you look at from December 20? But a large part of the move, as all of you are aware, happened in this calendar year, because the RBI started increasing interest rates in May. Now, policy rates in India have gone from 4% to 5.9. That's what is there in the first row. But what I'm saying here is the effective tightening in India is much higher than 190 basis points. Now, why I'm saying that is because if you look back, when you were operating at 4%, or the policy repo rate was at 4, but the overnight rate was at 3%, because you were operating below the reverse repo. That point in time, you had almost 12 lakh crore of excess liquidity in the banking system. So your operating rate was not 4. The operating rate was around 3, between 3 to 3/4. That is where you were maybe a year back, or maybe even 9 months back. From there, today the operating rate is close to 6. So even though policy rate has gone up 190, the effective rate in the system has gone up by almost 300 basis points. And across, if you look at, say, treasury bills, for example, which are more sensitive to interest rates, the treasury bills at the shorter end have gone up by almost 330 basis points. So in India, a large part of rate adjustment, we think, has already happened, because the effective tightening is much higher than what is being denoted by where the policy rates are. So compared to the other, I would say, especially the developed markets, the withdrawal of monetary accommodation in India has been faster, and the effective tightening that has happened is higher than what is implied by increase in policy rates. So today you have a situation where the curve is broadly flat. Bond yields are close to 7.5 from any. I'm talking about government security yields. At the 5-year bond and the 10-year bond is closer to about 7.5 to 760 is where the rate has traded in the recent few days. So you have a situation where bond yields have gone up substantially. Policy tightening has been much higher than what has been implied by the policy repo rate. That's number one. Secondly, end of the day, what really matters is to what extent do you think the policy rates are likely to go. Now, we believe that unlike some of the other central banks in India, we are closer to the end of policy rate tightening. So this is a chart that shows how the policy repo rate has moved. We are at 5.9 today. Now, again, when we say that, or rather, why do we think that we are close to the end of policy tightening? Now, end of the day, what is important to look at is what are the real policy rates on a forward-looking basis. Now, how do you determine that? You have policy rates say today at 590. We think that over the next few months, the policy rate could potentially go to 6.5. And RBI is likely to hold that 6.5, given that the forward-looking estimate on CPI today is about 5/4. 5/4 to 5.5 probably is a broader range of all estimates on consumer inflation on a forward-looking basis. So at policy rate at 6.5, forward-looking CPI estimate of 5.5 on a higher side, you are at 1% real policy rate, which is what we think. Again, this is based on what is RBI's published literature, where they have in the past talked about a broader range of 1% real policy rate as a neutral level. And I think this is where we are likely to go over the next few months. So that's a second reason why we think. So first, as I said earlier, in the first slide, the effective tightening has been significantly higher than what has been implied by policy rates. More than tightening, we've taken out liquidity as well. The second is we think on the repo rate, given this framework of 1% real policy rate at 6.5, we should be at a stage where the RBI should be able to pause. That's the second reason. Now, third, if you look at real rates from a market perspective. Now, this table, what we've done here is the first column is basically where the 1-year treasury bills were trading at the end of each calendar year. So if you look at the first row, calendar year 17, 1-year T-bill rate at 642, that end of December, this is where the 1-year T-bill rate was trading. And the second column, which is CPI, 4%, is actually the realized CPI inflation in the calendar year to 18. So 2018, the actual CPI average was 4%. So you would have got a potential, you would have got a realized real return of 2.4 by investing in 1-year T-bill at the end of calendar year 17, and that matures at the end of calendar year 18. So this is what we've done here, just to sort of give you another framework on the basis of which we think why Indian fixed income is getting to a point where one has to really look at it, and valuations are really getting to a zone where you have a lot of comfort and a lot of buffer. Now, where are we today? So the latest T-bill, and say if you look at the last 3 years, 19, 20, 21, broadly 2021, that's been the time when rates have fallen. There was a significant liquidity infusion into system. If you look at calendar year 21, at the end of, you had the T-bill rates were at 4.25. This year, the expected inflation is about 680. Someone buying a T-bill at the end of last year would have got negative return of 2.5 on that's a real return, adjusting for impact of inflation. Now, at this point in time, with the 1-year T-bill close to 6.95, I think the last auction cutoff, the expected inflation, even if you assume to be 5.5, you are looking at 1.5 to 175 basis points real rate. Now, this is why we think, compared to the recent past, where the last 3 years saw negative return adjusted for inflation, purely buying 1-year. 1-year T-bill is just a proxy for market interest rates, or rather a proxy for where a very safe risk averse portfolio on the fixed income space would today generate. Now, if you buy a 3-year GSEC, it could be 735. So effectively today you have reached a stage where positive rates are available based on 1-year expected inflation estimate. And now, again, this is on a sovereign curve, the same. Now, the lower chart basically is where the yield curve was a year back, and the blue line on top is where we are today. So again, as I've shown in the earlier slide, this shows how much the yield curve has shifted over the last few months. And the same framework, you expect that the 1 year ahead, even if you expect that 1 year ahead inflation is not going to be 5, say it is 6, you still have positive rates across the curve, which wasn't the case a year back. So the reason why we are saying that there is a case for actively engaging with fixed income today is this, a year back or maybe 6 months back, the framework wasn't favorable at all. Today, even assuming a worst case 6% 1 year ahead inflation, current yields still provide you positive rates, which wasn't the case for the last 3 years. So that's really I think a persuasive argument for starting to look at fixed income. At the same time, this is again a broad summary. Is it that there are no risks around and it's all clear from a risk perspective? So we would. So when you're looking at any investment, one definitely needs to look at the overall angle. So this broadly gives the framework based on various variables. So you do have certain issues which are still likely to create volatility in markets. Our base case still remains that, as I said earlier, there is a little bit more of tightening to go in India. We are at 590 policy rate. This is likely to go to 6.5 at least. There is likely to be a lot of volatility as we go forward, given that there are a lot of external event risks, given what's happening on interest rates globally. Domestically, we still have inflation which is fairly elevated today, even though it is expected to come down. Now, if you just look at some of these factors which are essential to look at when you are considering fixed income investment. So if I take one by one, I'll just take the factors which are negative or the potential risk factors at this point in time. One very clearly is the global factor. As the whole outlook on inflation is much worse in the global context than where we are today in India. So you have a situation where global central banks would continue to tighten monetary policy going forward. Our base case remains that interest rates globally will stay higher for a bit longer. Uh, I don't see, we don't really see a pivot coming anytime soon. So that is something which is negative because there are spillover effects. The other negative, how does this impact or how do they impact Indian fixed income? Essentially through the currency route, because as interest rates move up globally, you could potentially see less of capital inflows into emerging markets. That can create, we've seen in the recent past how the currency market has reacted. So the spillover effect will come in through the currency angle, which is another factor that one needs to watch out for. The third is a domestic, which is liquidity. As liquidity conditions tighten, it's quite likely that interest rates or market yields will have to adjust upwards. I would say the vulnerability on tightening liquidity is far more for corporate bonds, given that where bond spreads are today. So that is another factor that one needs to look at. And the fourth potential negative is the demand supply equation for sovereign security, because today we are seeing credit offtake picking up, deposit growth is lagging, to the extent that the last few years the banks have actually been a large buyer of government securities. As credit offtake continues to pick up, we need to see how this demand supply equation matches up. So these are some of the negative, but at the same time there are a lot of overweighing positive factors from a fixed income perspective today. Inflation, as I said, even though today it is elevated, the expectation is that it moves down into the policy target band and gets closer to 4% over a period of time. So inflation from today on a forward-looking basis seems to be favorable from a domestic fixed income angle. Policy rate, again, as I said earlier, we think we are closer to the end of the policy tightening cycle. Growth, this year we have a expectation that growth would be about 7, but given the fact that we are seeing the effects of tightening interest rates, tightening liquidity globally, and more importantly, a potential recession in in the global context. We could potentially see our growth rate drifting down. So, as you go forward from a monetary policy, domestic monetary policy angle, what is important is to see how growth inflation equation matches. So, with inflation likely to be about 5 on an average, 5.5 for example, and growth likely to trend lower to 5, which is what we think it is, the whole equation changes from a monetary policy perspective. So at some point in time, monetary policy will have to factor in that. So that on an incremental forward-looking basis from a market perspective, growth is a very positive. I'm talking about fixed income market perspective in the Indian context. And something which is the last one, we don't really talk about valuations in a fixed income context. We continuously keep comparing PE multiples and all the other ratios on the equity market. But why shouldn't we look at valuations from bond market perspective? So the previous charts, we did try to put in a perspective as to why valuations are favorable. And the metric that we used was real rates. End of the day, real rates do matter. Today we are seeing real rates being positive on a forward-looking basis. And that is something that is very, very important to look at this point in time. So valuations are extremely favorable from a fixed income domestic market perspective. Apart from that, carry is substantial today compared to where we were earlier, and with a flat curve, which is more or less what we are seeing today, without taking additional duration risk, you are able to get a carry of about 7.5. When you're looking at about 7.5 on a 5-year government security today, or any fund that is actually benchmarked or indexed to the 5-year government bond. So this is just one comparison that I am giving. If you go down to 3 years, again it's closer to 7.30, 35. So purely from an absolute carry perspective, fixed income is attractive today. From a real rate perspective, compared to what we were last 3 years, it's definitely attractive. And even maybe on a relative basis against equity today, there is a case for being more positive incrementally on fixed income. Uh, and finally, where does value lie? We talked about the broader fixed income value perspective in the sense that how interest rates are likely to evolve, what are the real rates available. But when you look down into the asset classes within the fixed income space, very, very clearly, we think sovereign securities offer value. And why do we think so? Just look at the column that is shaded. This is what the spread that is available. Now, why do you invest in corporate bonds? You invest in corporate bonds because you want to take advantage of the additional spread that is available. And why is the spread available on a corporate bond? In a very simple sense, the spread compensates you for the incremental credit risk you are taking, and to some extent the incremental illiquidity risk that you are taking on a corporate bond. And I think historically, the AAA PSU corporate bond spreads are at least 50-55 basis points. I'm talking about a long period, 10-year plus average, but there have been periods when spreads have been 75, 120 basis as well. Today, we are in a situation where one, interest rates have gone up. Two, liquidity has gone from extremely surplus to tight, or rather extremely surplus to neutral, and probably will get into deficit at some point. And what are the spreads that you get on corporate bond? 3-year spreads, 17 basis point, 5-year 8 basis point, and 10-year about I don't think even 18 is available, but I mean it's about 18 odd basis. So at these levels, corporate probably, very clearly do not provide much value, and value lies in sovereign securities such as government securities and SDL. So I think this is a broader context where we are in an overall fixed income perspective. Now, how do you take advantage of some of these opportunities? DP did mention about some of the products like target maturity funds on the sovereign space. I would again reiterate sovereign space. Sovereign yield curve is broadly flat. As you see in this particular table, corporate bonds do not provide you adequate spread, and that effectively means that they do not provide you enough value over the sovereign on a relative basis, relative return risk perspective. So there are these products which are very similar to an FMP, or where you can easily compare against FDs. So that is one space where people who are looking at a broader predictable yield and whatever maturity range they are comfortable with, you could potentially look at that. Actively managed products, again, because today we are in a phase where to a large extent the interest rate adjustments have happened. Definitely we think there is a little bit more adjustment likely to happen, as I mentioned earlier, given some of the risk parameters. And at some point we are looking at interest rates picking off and then over a period coming down. And the best way to play that particular again, starting today, we're not, had it been a case 6 or 7 months back, there wasn't any value in fixed income. But today, given where we are on the rate cycle, there is a place for actively managed products as well. So the benefit of falling interest rates at some point in time can be obtained through investment in actively managed portfolios, and essentially portfolios which are at this point more anchored to the sovereign space. And products like dynamic and government security open-ended fund, they are the ones which are really suited to take advantage of those opportunities from a falling interest rate regime at some point. So we're not looking at interest rates falling immediately. It's largely a case where interest rates are likely to top off. Even today, rates are extremely attractive, given the reasonings that we've given earlier. Over the next few months, we think there would be a bit more of volatility. So people with that appetite for taking an additional interest rate risk could potentially look at some of these actively managed products. So that is a broader perspective and the product range that we think would be attractive from current market perspective. And again, more than that, forward-looking estimate on where we think interest rates are likely to go. So what I'll do is I can stop here, and maybe Sandeep, you can take over.
So I think very helpful explanation of the situation which is prevailing today. So we also have with us Mr. Dinesh Ahuja, our senior fund manager and our go-to man for our innovation funds. He's also managing the target maturity funds that we have launched recently just for everyone's information, we have 4 target maturity funds which are available today: 2026, 2027, 2029, and 2036. I think 2 or 3 messages which I get before I hand it over to Dinesh from the message which Rajiv was trying to give. One is that probably we are nearing to the peak of the rate hiking cycle. That was one message which I got. Second message was that today, once again, the real rates have turned positive as far as debt investments are concerned. And third, very important point from an investor's perspective, and why a distributor should be very, very aggressively positioning debt funds today, because when you compare the valuations of equity vis-a-vis debt, debt looks much more attractive than equity today. So I think this is what we have to keep in mind. And debt today is offering you a higher carry. Along with that, the capital gain which you are going to get, which may be back-ended, which will happen maybe 1.5, 2 years, 3 years down the line. Collectively, the carry means the YTM of the product plus the capital gains definitely offers very, very attractive returns from a 3 to 5 year perspective for a debt investor. So therefore, our request to all of you would be that we have to look at debt funds more seriously today, even from the perspective of the valuations when we compare debt funds with equity funds. So now I'll request Dinesh to kindly take you through the product specific things. So what we are recommending today is that for a long-term investment perspective, you should look at the 4 target maturity funds that we are having. And also for those who probably have such kind of investors who can bear the volatility, the interim volatility, actively managed debt funds can be much more rewarding. And so probably I'll request Dinesh to kindly focus on both these pieces and share his thoughts with you. Over to you, Dinesh.
Hi, good evening, everyone. So, like we've been discussing, I'll just lay emphasis on 2 strategies today. The first one is the target maturity funds. These are very similar to fixed deposits. Not exactly same, but very, very similar. You have some predictability on the kind of returns an investor can generate over the time period the fund is in existence, right? So just to take it very simply, a 5-year target maturity fund, we will invest in securities which are going to mature on that particular maturity date. So today, when we launch a 5-year target maturity fund, we buy 5-year papers. 3 years later, when we get more flows into the fund, we will buy only 3-year residual maturity papers because the fund is going to mature in 2027. So that's very simply put what a target maturity fund is. Now, investor investing today we have a 5-year SDL product, which is in the range of about 7.5%. Investor coming into this particular product would get broadly 7.5 minus expenses. Yes, what this assumes is whatever the coupon flows come in a SDL, you get coupon flows every 6 months. Now 6 monthly, whenever the coupon comes in, we have to redeploy that money, and that is the only certain amount of reinvestment risk that the fund has. If tomorrow interest rates go down and instead of 7.5%, that coupon is invested at 6.5%, so there will be a marginal fall in overall return. But keeping the current interest rates in mind and keeping the fact that mutual funds offer indexation benefits, right? Most of these target maturity funds, investors could generate anywhere in the range of 6.5 to 7% tax free. Now that is very, very attractive. If you remember in 2011-12, you had tax free bonds coming in. People tried to lock into the longest, though the yield curve was flat. A 5-year tax free vis-a-vis a 15-year tax free was not offering much of a difference. But people said, no, I want to lock in for the longest tenor, and those are very attractive investment opportunities. Today, the government bond curve is offering a similar kind of an investment opportunity through the mutual fund platform, right? Because of the indexation benefit. Now, while the 5-year SDL is giving you 7.5%, the 10-year GSEC is giving 7.5%, the 15-year GSEC again is giving you about 760. One could question, why should I invest in a 15-year? Why not only in a 5-year? So this is the reason why I mentioned about the tax-free bonds. Today, we feel that interest rates are broadly at the upper end of the range. right? And one should lock in into the longest tenor possible depending upon your investment horizon. So if you have money, if your investor has money, which you would not need it for the next 10 to 15 years, we are recommending go in and lock in the longest tenor possible. Second reason why we say longest tenor possible is because we feel we are strongly of the opinion that India structurally interest rates are headed lower. If you compare our current interest rates with what they were in, let's say, 2000, 2005, we are far lower today as compared to that particular range. But in 2000, 2005, a State Bank of India was offering FD rates between 8 to 10%. Today, FD rates are in the range of about 6.5%. And the way India is progressing, we feel that we are of the opinion that in the next 5 years, 7 years, 10 years, interest rates would be lower. So if you lock your money for a 5-year tenor, 5 years later there will be a reinvestment risk on the entire principal amount, not only on the interest component, but even the principal amount. There will be a reinvestment risk, and therefore we are recommending try to lock in into the longest tenor possible if you have the time horizon to stay invested for that long. Now, we've got various products, 5-year, 7-year, we're planning to launch a 10-year, then we've got a 14-year and another 30, 40-year, which we're planning to launch. You could devise different strategies depending upon your investors' requirements. Now, I heard that investors do want regular flows, right? Maybe 8%, 10% of regular income, for their regular expenses. What investors could do is put in certain portion in the 5-year, put in certain portion in the 7-year, and put in certain portion in the 14-year. As the 10-year and 30, 40-year comes in, you could allocate more there. I would recommend investors, when they come into a mutual fund platform, stay invested for minimum 3-year period, because you get indexation benefit. So what you could do is, after the 3 years, you could start redeeming certain portion from the 5-year product, right? The mark-to-market component that comes in after 3 years, it will be mark-to-market for a residual maturity of 2 years. Therefore, mark-to-market will be limited. Even though we are of the view that interest rates are headed lower, in an adverse scenario where interest rates are high, the remaining mark-to-market for a 2-year product will be limited, and therefore you could start withdrawing from a 5-year product. As the 5-year matures, then you could start withdrawing from the 7-year product, which again would have a 2-year residual maturity, and therefore interest rate risk is less. After the 7-year, you could start withdrawing from the 14-year, or when the 10-year comes in, you could. So these are different strategies. This is one strategy that I'm recommending because every investor would have a different sort of a requirement. You could look at the requirement of the investor and start allocating whatever portion you want to. But I would strongly recommend that a certain portion, or a probably slightly higher portion, go into the 14-year, and as the 30 or 40-year comes in, start allocating there. Because, like I said, we are of the view that rates are headed lower. Interest rates in India structurally are headed lower, and therefore there will be a significant reinvestment risk as maturities of the 3-year and 5-year come in. So therefore, block in a significant portion on the longer end, where investors would stand to gain. Now, as compared to fixed deposits, even today, a 5-year fixed deposit is at about 6.5% for a normal investor, not a senior citizen. Senior citizen would be slightly higher again, but for a normal investor, it's 6.5%. Vis-a-vis, and again, there you have your tax rates are high as compared to our mutual fund platform, where a 5-year government security. One point I would like to highlight is there is no credit risk that we are talking about here. This is the entire investment is getting into sovereigns, either SDLs or into GSECs. There is one particular fund where there is 50% into SDL and 50% into AAA PSU bonds. So credit risk is absolutely zero to very, very marginal, and therefore one doesn't need to worry about that particular aspect. And rates that I was talking about, a 5-year fixed deposit is at 6.5%, or 5-year GSEC is at 7.5%. The curve is flat, so therefore the 14-year and 30-year GSEC is between 760 to 775. So levels are attractive, very, very attractive as compared to fixed deposit rates. You have an opportunity here to lock in into longer tenors. Fixed deposit usually doesn't come for very long tenors, and therefore you have an opportunity here to lock into even as 30-year as the fund product comes in. And investors should definitely use these platforms to lock into longer tenor investments to avoid reinvestment risk. Again, mutual funds gives you indexation benefits. So put both these two, attractive rates and indexation benefits, like I indicated, returns could be anywhere in the range of 6.5 to 7% on a tax-free basis. Assuming inflation stays between 5.5% over a next 5-7 year period, one could generate those kind of returns. So that is one particular strategy that I spoke about. The other one that I want to speak about is the open-ended gilt and the dynamic bond funds. Why these two products particularly, given the basket that we have, and we are talking about these two because again, these two products predominantly focus on sovereigns. Government security fund invest only in GSECs. Dynamic bond fund currently is invested only in GSEC. It has an opportunity to invest in AAA bonds, but like Rajiv indicated, the spreads are not attractive, so the focus is completely on government bonds today. These two categories, again, from a longer term perspective, look very, very attractive. Post 2013, investors have allocated very negligible proportion of their investments into duration products. In fact, this is the first time after 2013 that we are getting an opportunity to market these products, saying that interest rates are attractive. While you saw intermittent rallies because of demonetization, you saw rallies because you got a pandemic in between, but these were not really fundamental rallies where we could really go and market our funds. I think this is the first time after 2013 that fundamentally we can say we are in the upper end of the range. Interest rates can go up marginally from current levels, but catching the peak and the bottom is practically not possible, right? And therefore, we are saying come into strategies like gilt and dynamic, where the fund manager has the flexibility to change duration. We are at low durations at this particular point in time. We've changed our average maturities over the last 2-3 months, trying to make alpha for our investors. And as interest rates peak out, as we get a sense that it is a peak out, we will increase duration in these funds. So, the investor stands to get protected even if interest rates go up to a certain extent from here on. The fund manager takes the call and protects the investors mark to market in these funds basically. So I think these two strategies, again, in the open-ended strategies are very, very attractive. Interest rates look like being at the upper end of the range as we head probably 2, 3, 4 years down the lane. I think these funds could generate reasonably attractive investment returns, and investors should look at taking availing opportunities from these funds. So very briefly about these two categories, and I think probably we could take up questions.
Yeah, sure. Thank you so much, Dinesh, for that perspective. So I will request everyone, मैं सबसे request करूंगा कि अगर आपके कोई सवाल हैं तो आप प्लीज चैट बॉक्स में लिखिए, नहीं तो अपना हाथ रेस कीजिए. If you have any questions, I will request you either to write in the chat box or please raise your hand so that we can unmute you. So Dinesh, Rajiv, I hope both of you are there.
Yeah.
So there is this question. So I will request Mr. T. Suresh. I'm unmuting you. Kindly ask your question, please. Mr. T. Suresh.
Thank you, sir. I think it's a good presentation. My question is in terms of, as you said, both of the fund managers here, you said from repo rates from 590 to 650, that means 60 basis point is what we are expecting. What's your view on the GSEC market? Already, is it discounting that 60 basis point which we are expecting, or is it about to be discounted? If it is discounted, then don't you think getting into a dynamic kind of fund with a 3-year horizon would be much better than going for a pure equivalent strategy? What's your thinking, sir?
Right. So if you look at historically, let's say we talk about 2010-11, the 10-year GSEC used to trade at about 70-75 basis point above the repo rate, right? And at that particular spread, we used to give a call that one should invest into duration products, right? Post that, you had 2013, which was a crisis period, and then the pandemic. Because of the pandemic, the fiscal deficit blew up, and therefore spreads of the 10-year GSEC went substantially higher. Liquidity was infused, and therefore the short end of the curve was far lower as compared to the 10-year GSEC. If we assume that the 10-year GSEC goes to 640, 650, and the 10-year GSEC, the repo rate goes to 6.4650, and the 10-year currently is at 7.5%. It gives you a spread of about 100 to 110 basis points, right? Now, assuming that we've gone through the pandemic, the fiscal is definitely improving. GST tax rates are pretty buoyant. As growth picks up, government tax revenues will improve further. So, the fiscal concern doesn't seem to be as much as what we saw in the last 2-3 years. It's far more, very, very better at this particular point in time. So, I think spreads, assuming a repo of 6.5%, the 10-year GSEC is discounted. It's pretty attractive, and therefore one should lock in into duration. Yeah. One should look into duration products. Why we are talking about these two strategies is we are not saying put in entire money into target maturity or put in entire money into gilt dynamic. We are saying you could proportion. See, investors do have separate amount of risk appetites, right? In the target maturity, there is a certain amount of visibility on the kind of returns that one can generate, and therefore it looks a bit more attractive for investors. But gilt and dynamic are equally attractive, and the opportunity lies in there. We as a fund house, we've been able to generate far higher alpha in our gilt and dynamic strategies, and we are very, very confident that these funds over the next 3 to 5 year period will deliver reasonably superior returns as compared to FDs or any sort of investment avenues available today. So depending upon investors' risk appetite, since you all are directly in touch with the investors, you all know that much better. In terms of the individual investors, you could recommend investors these different kind of strategies, whether target maturity or open-ended. If the investor is willing to take a slightly higher allocation to gilt and dynamic, I think they will be fairly rewarded. So I think you could look at the risk appetite and suggest to investors that as to go to the
3 year looks decent, sir. If I ask you 3 years plus, is it right?
Yes. I think a minimum time frame of 3 years should be there. The carry, right? The carry itself is so attractive that any marginal mark to market even after 3 years, even though we are confident that rates will be lower, but let's say in an adverse situation, but the carry itself is so attractive that it compensates any sort of a marginal mark to market, negative mark to market that comes in at that particular point.
Sir, one more follow-up question. Why don't you come out with a 2051, 2062, where I think the yields are pretty 7.6?
This is Dinesh's favorite question.
Yeah, okay. So why don't you come out with that 2051, 2062? The rates are pretty good, and as you said, after 5 year, 10 year down the line, getting 5% would be tough. I know to have a accrual strategy, just buy, sit tight, and get the benefit of higher interest. That's your question.
Yeah, I take your point, sir. We've already done the requisite requirements at our end, so it is lying with our regulator. So once SEBI gives a sign off, we should be able to launch.
But otherwise, it's a good idea if you are long term.
Yeah, it is. It's
so while we are talking about this particular product, I would just like to highlight a few facts and the benefits of investing in this particular product. Obviously, when someone comes into a 30 or a 40 year product, the investment time horizon has to be slightly longer, right? I mean, at least let's say 7 to 10 years. Now, considering that a 30-40 year GSEC is at 6.75, removing marginal expenses, an investor could generate, almost double the money over a 10-year period, right? So 100 rupees gets into about 190 rupees over a 10-year period. Now, even at that particular point in time, let's assume that interest rates are higher by 100 basis points, right? I mean, that's a very conservative estimate. The investor loses about 12 to 13 rupees, considering the residual maturity would be 20 to 30 years, right? Even then, your net XIRR comes to about closer to 6%, right? Even assuming 100 basis point of a mark-to-market loss at that particular point in time. And here, we've done some calculation. We are assuming a reinvestment of coupons at anywhere between 5 to 6%. Even then, the investor gets about 6% of an XIRR. So from a risk-reward perspective, I think it's a fantastic product. And, while we talk to investors, it is very important to educate them that in a fixed income, there are two portions of incomes that one generates. One is from the accrual and the other is from the mark to market. Over long term strategies, the mark to market becomes very, very negligible, right? The main income that an investor earns is through the accruals, and if you stay invested over longer time frames, a little bit of a negative mark to market 5 years, 10 years down the lane is hardly impacts your overall returns. I think that is something which is very important that we need to tell our investors, because looking at daily NAVs, the investor gets a bit panicky saying that negative returns over a 6 month, 1 year period. If the investor stays through over longer time frames, I think the mark to market is a very negligible amount, and considering that rates are very, very attractive, investors should look at locking in from a longer tenor. In fact, we get a lot of queries for a 30-year product, 40-year product. We've applied to our regulator, just awaiting approvals from them before we go ahead and launch one.
Thank you, sir. Thank you, sir. Thank you.
So I'll request our team members also. I suppose they are sitting with a lot of IFAs within the office also. If you want to ask some questions, you will have to tell me how to unmute you because I can't see any branch names here. So please let me know either through a WhatsApp and I will unmute you. So let us go to let us take a couple of questions which have come in the chat box. This is something which is interesting, but I think let's. You have already, briefly you have replied about it. In last 10 to 15 years, did SBI Gilt and SBI Dynamic beat the passive strategy? So there were no passive strategies at that time. That is one thing. But Dinesh, somebody has to ask you Dynamic or say SBI 236 Gilt.
Right.
So, what would you prefer?
So, I would answer this question in this manner. 10 years back, if someone would have invested in a 10-year or a 15-year GSEC, our active strategies have outbeaten, passive. So, like you said, passive investment strategies. So, just investing into a 10-year GSEC and coming into the dynamic bond fund or the Gilt fund, both these strategies have beaten the plain vanilla GSEC, because we've been able to get our broader interest rate calls right. Yes, it's not that every call goes right, but as far as you get the broader interest rate calls right, I think that's that's what is needed basically. And we've been successfully been able to do that over the last 10-15 years, and these strategies have delivered better than passive strategies. From a recommendation perspective, I think it's an allocation. One can allocate to both strategies depending upon your risk appetite. If an investor is willing to ignore the near-term volatility, one could come into the Gilt dynamic bond funds. Otherwise, target maturities. If you want some visibility on the kind of returns, obviously target maturity is the place to be.
Yeah, and एक दो क्वेश्चंस और जो आए हैं, थोड़ा सा अगर आप लोग दोनों से रिक्वेस्ट करूंगा हिंदी में भी थोड़ा बीच में बोल लीजिए.
Sure.
It will be very helpful. So another question which has come is, it's in the chat box. So I'm just taking. There are so many questions. This is a very, very basic question, and I think ये हमें ये बता रहा है कि हमारे को टारगेट मैच्योरिटी फंड्स को थोड़ा और आसानी से सबके लिए एक्सप्लेन करना है. So I think people still don't know exactly what a target maturity fund does. So I'll request any one of you, Dinesh, Rajiv. So there is this question, sir, please give example if a customer puts 10 lakh rupees today, what he will get after 3 years in a target maturity scheme. Also, tax liability, what would be the tax benefit?
Okay,
so you guys will take or I should take? I don't want to.
You can take.
Huh?
You can take it.
No, but let's hear from you, and then maybe if any addition is needed, I'll do.
It's simple. Now, so for example, you said 3-year target maturity fund. Now, we are all familiar with FMPs. That what you do in an
So Rajiv, why don't you take 2026, which is a 4-year, which is a target maturity fund that we have.
Okay. So 2026 September is the maturity date. Now, in that particular fund has a certain index. it has an index which is constituted 50% SDL, 50% AAA bond. So that becomes your universe. Now, what you do or what we do is, as inflows come in, we buy papers which are maturing closer to the maturity date based on what issuers are there in the index. Say, for example, index has 5 PSU bonds and say 8 or 10 SDLs issuers. So we have to essentially buy papers which are from those issuer basket. Of course, there is a bit of a leeway which is there, but I'll not get into that. So it is as good as an index fund. Now, the only difference between this and an FMP is the ongoing liquidity. FMP mein, once you get inside, you don't have a ongoing liquidity, whereas in a target maturity fund, it's an open-ended product. There is always the benefit of, if at all at some point you need liquidity, you can always redeem. Now, beyond that, there isn't, apart from the liquidity angle, the other difference is an FMP does not, you don't need to follow an index. So what we have is an FMP might have a asset allocation range where you say that say 50% will be in GSEC and 45 to 50 will be in AAA bond. But which bond, that is not denoted. Whereas in these funds, since there is an index has certain bonds, it has certain SDL, you can only buy those which are part of the index. So that is one difference which is there in a target maturity or which are similar roll down fund as compared to an FMP. What is the
Another
benefit?
thing probably that I can add,
Yeah.
Rajiv,
Yeah.
in addition to what Rajiv has said, जो Rajiv ने अभी बोला उसके अलावा, this question was that if you invest 10 lakh rupees, so what is the YTM of that product today? The YTM of that product is around 7.5. There is an expense ratio of that product, which is about 35, 30 or 40 basis point. So 750 is the YTM minus expense. That is the indicative return.
तो
It is
इसमें
only indicative because there are, please Rajiv.
इसमें जो indicative जो word है, that is very very important क्योंकि there is always an element of reinvestment of coupons. अगर से आपका जो underlying investment could be in a mix of SDL और SDL में every 6 months you get the coupon. अगर bond रहेगा तो bond का annual interest payment रहता है, so that needs to be redeployed. So I say 1 year later you have received coupons, I have to go and redeploy it. Today's yield is say 7.5. Say I have bought 7.5 maturity 3 year. Let us for simplicity assume that the underlying is only SDL. 100% SDL, target maturity September 26. What do? You go and buy the 3 year SDL at say 7.5. That is the current interest rate. But SDL में every 6 months जो coupon जो आता है, that needs to be redeployed. So 6 months later, when the coupons come in, say for example at that point interest rate is 5%. I'm not saying that it will be 5% after 6 months. Just for example's sake. So at that point, you need to basically the coupon redeployment will happen at that rate. So effectively, when you talk about YTM of the fund, you are effectively assuming that every coupon is getting reinvested at that YTM. So unless all the coupons are reinvested at that, so that is why we say the yields are broadly indicated.
So I'll just add here. So very simply, आपने 10 लाख की बात की, मैं 100 रुपए के हिसाब से मैं आपको बोलूंगा कि एक्सप्लेन करना भी इजी हो जाता है कि सपोज एक इन्वेस्टर ने आज 100 रुपए में इन्वेस्टमेंट के लिए दिए, आज हम वो 100 रुपए का 4 साल का पेपर खरीदेंगे. हर साल अज्यूमिंग 7.5% का कूपन है, जो भी है 30-40 बेसिस पॉइंट एक्सपेंस आएगा. So 710, let's say 710, or let's say simply speaking 7 rupees is what the investor gets out of the coupon. Over a 4-year period 7 rupees हर साल, आपको 4 साल बाद 28 रुपए, तो 100 रुपए becomes 128 प्लस जो 7 रुपए हर साल हमें मिलेंगे वो हम उसको वापस रीडिप्लॉय करेंगे. वो रीडिप्लॉयमेंट का रेट इज अनसर्टेन, बट अगर हम अज्यूम कर सकते हैं उसको 5% पे डिप्लॉय किया या 6% पे डिप्लॉय किया, वो जिस रेट पे हम रीडिप्लॉय करेंगे 1 साल बाद, 2 साल बाद जो 7 रुपए आएंगे, 3 साल बाद जो 7 रुपए आएंगे, वो रीडिप्लॉयमेंट के बाद आपका जो 128 रुपए है वो 130 135 डिपेंडिंग अपॉन द रीइन्वेस्टमेंट रेट ऑफ द कूपन, आपका वो 100 रुपए बिकम्स 100 एंड लेट्स से 32 135 रुपए. सो दैट इज वेरी सिंपली स्पीकिंग कि इसमें कैसे रिटर्न जनरेट होगा. दूसरी एक क्वेश्चन आती है कि आज इन्वेस्टर आ गया 7.5 पे, एक सिंस दिस इज एन ओपन एंडेड प्रोडक्ट, सपोज एक साल बाद इंटरेस्ट रेट था 6.5%, तो मेरे इन्वेस्टर का कैसे रिटर्न 7.5 होगा, बिकॉज तभी हमने और न्यू पैसे आ गए, हमने तभी उनको 6.5 पे डिप्लॉय किया है, तो मेरे इन्वेस्टर का रिटर्न इंपैक्ट होगा? वो नहीं होगा, बिकॉज आज जो इन्वेस्टर आया है 7.5% पे, उसका पैसा हमने 7.5 पे डिप्लॉय कर दिया है. एक साल बाद जब भी इंटरेस्ट रेट 6.5 पे है, जो 100 बेसिस पॉइंट जो नीचे गया है वो एनएवी में इंपैक्ट आ चुका है. तो जो नया इन्वेस्टर आ रहा है 3 साल के प्रोडक्ट के लिए, उसको रिटर्न मिलेगा 6.5. सो आज जो इन्वेस्टर आ जाता है उसके लिए रिटर्न लॉक इन हो चुका है. ओपन एंडेड प्रोडक्ट है, इसके वजह से करंट इन्वेस्टर को का रिटर्न ऊपर नीचे इंपैक्ट नहीं होगा.
Yeah. So, there is one more question before I go back to the, live audience. अगर सिंपल भाषा में दिनेश आपसे पूछा जाए कि एसबीआई म्यूचुअल फंड के कौन से प्रोडक्ट आप आज की डेट में रिकमेंड कर रहे हैं, तो आई एम श्योर आपने टारगेट मैच्योरिटी के बारे में बात किया, आपने डायनामिक के बारे में बात किया, मे बी शॉर्ट टर्म के अंदर, एक्सट्रीम शॉर्ट टर्म के अंदर भी, आप कौन से प्रोडक्ट टाइम होराइजन के हिसाब से आज की डेट में एसबीआई फंड हाउस के आप रिकमेंड करना चाहेंगे?
So extremely long end में very bullish on gilt and dynamic. I'm very positive on rates from a 3 to 5 year perspective. Near term definitely rates ऊपर जाने के chances है, but gilt and dynamic अगर आज मुझे खुद का पैसा अगर allocate करना है तो मैं पहले gilt dynamic में allocate करूँगा. That is my recommendation. Target maturity funds again like I'm saying, investors को अगर थोड़ा visibility चाहिए, you can allocate, but again देखिए 14 ईयर जीसेक में आप allocate करोगे तो आपको एक इंडिकेटिव रिटर्न तो है, लेकिन उसमें भी आपको मार्क टू मार्केट 3 ईयर 5 ईयर के बाद इंपैक्ट मिल जाएगा, राइट. गिल्ड डायनेमिक में इसके लिए मैं कहता हूँ कि इंटरेस्ट रेट ऊपर नीचे जाते रहते हैं, हम उसको वो मूवमेंट का बेनिफिट लेते हैं, देयरफॉर अल्फा जनरेट करते हैं. टारगेट मैच्योरिटी में वो अल्फा ऑब्वियसली नहीं जनरेट कर पाएंगे, बट स्ट्रक्चरली जैसे नीचे रेट जाएंगे, even the 14-year target maturity will stand to gain basically. So these are products. Investors को अगर short end में आना है, obviously liquid, ultra short term, low duration, that is
1 year FMP also.
Yes. तो वो investor के time horizon के हिसाब से आप वो recommend कर सकते हैं. Short term funds again काफी सारे short end of the curve में repricing हो चुकी है. दो हमें लगता है कि शॉर्ट एंड थोड़ा और प्रेशर में आ सकता है, क्योंकि अगर इन्फ्लेशन को कंट्रोल करना है, पर्टिकुलरली फ्रॉम यूएस पर्सपेक्टिव, हमें लगता है कि वो लिक्विडिटी को टाइट रखेंगे. इंटरेस्ट रेट्स में भी इंडिया में हमें नहीं लग रहा ज्यादा ऊपर जाएगा, यूएस में थोड़ा और ऊपर जा सकता है, बट इंडिया में भी लिक्विडिटी टाइट रहेगी, तो इसके लिए शॉर्ट एंड में थोड़ा सा और प्रेशर रह सकता है, बट वो भी उधर भी काफी कुछ प्राइसिंग हो चुकी है सिक्योरिटीज में. सो अगर आपको उधर भी इन्वेस्टमेंट करना है तो यू कैन लुक एट, बट मोस्ट ऑफ द अल्फा आई थिंक ओवर द नेक्स्ट 3-5 years will be generated from the duration products.
Right. So we have our branch from I think Ranchi is there on the line. I have unmuted you. Please go ahead. Lagan?
Yeah. Yes, sir. Just wanted to ask, जैसे 4 year टारगेट मैच्योरिटी फंड है आपका 2026, अभी इन्वेस्टर उसमें एंटर करता है, 2025 3 years डाउन द लाइन उसको अच्छा रिटर्न बन रहा है, उसका 3 year का देख रहा है, मेरा टैक्सेशन का भी बेनिफिट मिल रहा है, quite a substantial part of the investors they exit. The remaining investors उनका क्या होगा सर?
So जैसे मैंने हाईलाइट किया, ये ओपन एंडेड फंड है, लेकिन इससे करंट इन्वेस्टर्स, एग्जिस्टिंग इन्वेस्टर्स को फर्क नहीं पड़ेगा कि फ्रेश इन्वेस्टर्स आए या जाए, बिकॉज वो सब कुछ एनएवी में फैक्टर हो जाता है. तो अगर 3 साल बाद जो इन्वेस्टर्स जाएंगे, हम उनके लिए हमें सिक्योरिटीज बेचनी पड़ेगी और वो एनएवी में फैक्टर हो जाएगा, बिकॉज तभी मार्केट रेट्स विल बी वेरी सिमिलर टू व्हाट आवर एनएवी इज फैक्टरिंग इन, राइट. सो इन्वेस्टर्स, whether fresh investors come in या existing investors move out, it doesn't impact the remaining set of investors.
Actually, one big advantage which is there, and most of these funds that we are coming out with is in very highly liquid, security.
Yes.
So therefore, one should not worry about investors moving out because there will always be a liquidity to the securities that we are holding, and there will not be any less liquidity impact on the NA. और कोई सवाल है उधर?
No, sir. Thank you.
Okay, so अरुण आनंद जी, मैंने आपको अनम्यूट किया है.
Yeah, hi. Am I audible?
Yes, sir.
Okay, hi. I'm an ex-banker and just wanted to ask you, I was personally doing a small Excel on target maturity funds. So what I have observed is while you guys have rightly pointed out in the target maturity, the word indicative is very important. The yield is YTM minus expense. But when I did final calculations, you also have another element which is called when you buy and sell bonds in between, it impacts the NAV. So finally, the difference in the IRR comes about 10 to 20 paisa plus minus over and above all this. So I wanted to understand from you that is this true at firstly, and number two, like I also deal in bonds directly. I sell to investors, like I sell SBI perpetual bond and other thing, where the returns is already guaranteed at the YTM. Obviously, so versus that and versus this for a client who's looking for a kind of a guaranteed return, what would be the strategy which you advise?
Sir, the first part, if I could just maybe I'll give my perspective and you could potentially stop me if I am not on the right track. So, as we said, it is indicative because apart from the yield and yield expenses, that's fine. The other uncertain element is at what rates do you reinvest whatever coupons that keep coming in during. So unless the portfolio is completely made of zero coupon bonds or say strips in government security cases, the return will never be yield minus expense because in a zero coupon you could potentially, you're just locking in that particular rate. There is no reinvestment risk. So the yield is locked in, expenses are known. So the return to the client is very, very predictable. But to the extent that there are bonds and all of these portfolios have underlying bonds and SDL where coupons come in, there is definitely an element of reinvestment. Now you are looking at a 4-year product, so you've got what 8 reinvestments that you need to do, which is again will potentially happen at different rates. It could be higher, lower, depending upon how the interest rates go out. The other source of leakage, if any, is potentially as to the extent that if incoming investors are coming in at the NAV, but the actual fund transactions are happening at different. Because say, if you have very, very illiquid underlying bonds in the portfolio, there will always be an element of gap. I think there will be a variation between where the transactions are actually happening and the price based on the previous day NAV where the client entered. So that's something that is there in very, very illiquid underlying portfolio. That will not be the case when you have a portfolio which is either SDL or GSEC because the transaction prices and the NAV, there would not be too much of a gap. So my sense is beyond these two, there cannot be anything else that that can explain the gap. And to to some extent, the reinvestment challenge is there in FMPs also, and we've actually personally seen that in the last year when a lot of FMPs of 19 vintage matured. And the reinvestment, we would have assumed 6.5% reinvestment. Effectively, the reinvestment happened at much lower rates because interest rates just collapsed post-COVID. But otherwise, I'm not really sure whether there will be any other source of leakage.
Yeah, I can share that local Excel with my.
Sure, you'll have a look. Will be because see for us also. These products haven't really seen a full vintage. At least we've done our first target maturity. We launched it in Jan of this year, which is going to mature in 26. So we are not really, at least at our end, we haven't really gone through that cycle where TMF products have matured and then we could potentially compare the final outcome. And I think a few funds in the industry could have completed those.
I tried doing some backtesting data on this, so that's why I was just coming to this.
Yeah, we would be happy to, we can engage separately. We would be happy to have a look at
No
it.
problem.
And the second question, sir, was on perps, I guess, right? Perps or bonds.
Yeah, it was like if I directly sell a bond to a customer.
Yeah.
So what happens is that I'm very sure it's a conservative client looking for a typically guaranteed, but not exactly a guaranteed. So which mutual funds, because of these indicative, the client sometimes is wanting to get something
Correct.
very sure which you
Right.
can't give.
Right.
So your perspective.
Yeah, so the trade-off is very clearly mutual funds provide you the benefit of indexation, whereas when you buy directly a bond and hold it to maturity, unless of course after a year or closer to maturity, you are able to sell it in the market, then you get a different, much more favorable capital gain treatment. So there are these trade-offs. So mutual funds, as I said earlier, unless the portfolio is completely made up of strips or zero coupon bonds, and of course there should not be any credit event at the maturity, you will get a targeted return which is very clearly equal to what is originally indicate or what is yield minus expense. So I mean, as long as you've got bonds where coupons have to be reinvested, you'll always have and I think it doesn't really vary significantly. So even in a 5-year fund, I mean, we've seen typically in our experience with FMPs, the reinvestment, because the larger part is the cash flow that comes at the end of the scheme. It doesn't really, I mean, I think 15-20 basis on an average, depending on what reinvestment rates that you take, is a broader gap between the yield and the effective net yield. And after the expense, of
Yeah,
course.
so just to add, so if you look at buying a bond by yourself, right, and an investor says, I want to buy the bond, even he will face the reinvestment risk of the coupon. It's not that he's not facing that risk, right? Mutual fund platform definitely offers better tax benefits, and from that perspective, it makes a lot more sense to come into the mutual fund, even though there is a bit of an expense. But from a reinvestment perspective, I don't think it makes much of a difference, because, like I said, the investor will face the same reinvestment risk from the bond itself. It's just that the perception when you talk about mutual funds, daily mark to market, and when we say indicative returns, I think these are facts into any other bond, right? You can buy a bond. If you do a mark to market there, you'll realize what's the impact on your overall return in the short time frame. So it is just a perception, but I don't think it makes much of a difference.
I think that's where the actively managed piece comes in, where you could potentially gain from active investment. Your reinvestment risk to a large extent is mitigated, and more importantly, the benefit of capital gains that can potentially come in.
And just a last follow-up question, and sorry I'm taking time.
No, sir.
That your view was that generally the interest rates and all would be like right now we are almost at a peak, and then pivot will happen, just like the US Fed eventually would pivot. But leading economists globally, I'm sure you have much more access to information in terms of your research team. But the view is that once the US will pivot again, the inflation is staggeringly high. And what eventually would happen is the economy is already in recession, which they're not declaring officially. So eventually, Fed will have to, print money and create more deficit and create further inflation, which will again spike up the bond yields. So for an investor with a 3 to 5 year period, again interest rates globally will go up, and accordingly India will also have to hike the interest rates. So while a pivot may happen in 3 years, again with a 5-year view, again it may go up. So we end up making really no return. Is that true?
So end of the day, there are cycles, right? I mean, similar to an economic cycle, interest rate cycles are also there. Now, what we are seeing is over the last 2 years, or post-COVID especially, you had a phase of declining interest rates. Now, with inflation having come up, the phase of interest rate cycle has turned, and eventually, at some point, you're right. I mean, you will eventually, the Fed, for example, at some point will pause. Then later on, they will definitely respond to recession or slowing growth by cutting interest rates, and maybe over a period again that sets a stage for the next round of. But I mean that's how rate cycles pan out, and probably in India, if you have seen, maybe to some extent, even though I personally do have, I can debate on the effectiveness of inflation targeting, but I think it has brought in some element of predictability or more stability to the rate cycle. Unlike in earlier phases when interest rates used to go up and down in short span of time, I guess the cycles are a little bit more elongated in our case compared to the earlier history. But no, I mean, that doesn't really take away from the fact that eventually at some point rates will again go up. I mean, that's how the cycles are.
Yeah, and just very briefly, that's why we said look at these two strategies separately. Allocation, maybe certain to target maturity and certain to open-ended. Open-ended can take the benefit of these rate cycles.
Okay, so there are a lot of questions, so I'm just going to move on. So I have unmuted Mr. Mukesh Kumar. Mr. Mukesh Kumar, are you there?
Yeah, hi sir, I'm here only.
Yeah,
I
please go
think,
ahead.
few of my questions have been already answered because I was looking for in very simple terms, what are the kind of product from SBI I should look at for the customer, like in terms of time horizon, in terms of risk appetite. So I think it's already answered. Like example, sir has already mentioned that if somebody is looking for looking at the yield perspective, then he can go for target maturity. And somebody is okay to hold for longer term, then yield is a better product.
Right, thank you. Thank you. Let's move on. Partha Investment Managers.
Very good evening to all of you. And see, I just one of my client was asking when regarding target maturity fund. So he was telling that he is very comfortable investing directly in the secondary market in tax-free bond. What his contention is that indexation benefit, which is there now, what happens if after within 3 years the indexation benefit gets removed, or even before I redeem after 4-5 years, it gets removed by the government, like what they did in the equity fund, where there was no long-term capital gain tax. Now there is a long-term capital gain tax at 10%. Because of this, he's a very conservative, but I was almost closing the sale. But this question he put, and then he got himself got a self-doubt that whether indexation benefit will continue or not. Tomorrow the government will. So how to advise, and what your take on this?
So that is valid in all asset classes, no? It is for equity. Tomorrow the government can say 30% tax on equity capital gain. Bank fixed deposits also. So if the government is really hard pressed for revenue, anything is possible. But having said that, would it really, end of the day, there has been this repeated refrain of deepening the market, deepening the bond market, widening corporate bond market. If you keep playing with taxation regime there, that objective will not be achieved. So I would personally, in fact, I would give the other counter question that it's all the more likely that at some point they will try to ease the capital gains on debt instruments, because if at all today, if there's a crying need to provide benefits, it is for the debt side, because eventually the market is not as deep as what they would want it to be. They keep talking about widening the market. RBI, for example, has gone ahead and introduced an RDS scheme for investors to directly buy government security. Effectively and then again they keep on talking about widening the retail base in mutual funds on the bond side. All that calls for some benefits or additional incentives to be given, maybe reduce the capital gain holding period. So personally, I would say, if at all, it's only likely to be in a positive manner, any change. But you can't, it is applicable for all asset classes. So I think you should be advising on that aspect, because these are factors that you can't control.
Yeah, one more thing is that I know many are giving the comparison between FD and the target maturity fund rate, the post-tax yield after adjusting the indexation benefit.
Yes.
Can I have some similarly on the tax-free bond and versus the target maturity fund, like some sample example?
Yeah, so I think tax-free bonds today are trading in the range of about 5 quarter or maybe thereabouts. So even as compared to that, the target maturity funds offer better tax-adjusted returns actually. But if you want, we could probably
No,
find
so
out.
simply put, when we give a comparison between an FD and a target maturity fund, you change the return that you are expecting in tax-free bond over there.
So yeah, so for example, let's say in a 4-year, post expenses, let's say the investor gets 7%. Now, if you assume inflation over the next 4 years is going to be 5%, do I feel it's going to be slightly higher? But let's assume 5%. Your net yield that you're getting is 200 basis points, 7 minus 5, right? On that 200 basis points, you have a 10% or 20% tax rate, right, on the indexation platform. So therefore, 40 basis point is your net tax. So out of 7, if you remove 40 basis points, that is 6.6 is your tax-free return. So that's the way we do a simple calculation.
Yeah. So thank you so much, sir, for your question. Let's move on to Mr. Chetan Damani. Mr. Chetan Damani. Sir, please unmute yourself and ask your question. Okay, maybe he's not there. We can, Mr. Vasant Prabhu, you can unmute yourself, sir.
Hello. Can you hear?
Yes, Mr. Chetan. Yes, please go ahead.
Good evening, my very good friend and my investors, IFS darling, DP Singh, if he is listening, Dinesh ji, Rajiv ji, and Sandeep ji. Season's greetings to you all. Now my question is, my client has invested a good amount in SBI savings fund.
Okay.
We are savings fund. We are waiting to switch to some other fund provided. So my question is, where do you see the horizon where interest rates will top up and bond yields will top up? Because I ask this question because in your chair you have got better vision than what I am sitting here. So can you please highlight the better vision for me and my clients, sir?
Okay, so I can answer the second part easily. When it will top, or rather give an estimate. So my sense is, as I said in the presentation, we think in India it tops off policy rate at 6.5, which will be done over the next 2 policy meetings. So most probably Q1 next calendar, we should be done. I think RBI should be done based on what data we have, what estimate we have today. We think they will stop around that time. Market rates typically tend to peak out before policy rate, but for argument's sake, let us assume that by end of the year or early part of next year, we potentially could see the peak in market interest rates. That's our best estimate based on the view and data that we have today. Now, the first question, I guess, now again, it's a choice of what exactly is the client's requirement, what risk he is willing to take, and what tenor is he going to invest in. So there will not be I always will hesitate to provide an answer on a very generic basis, because a dynamic bond fund or a GSEC fund may not necessarily be suitable for a risk appetite of every investor. So very clearly, I think, sir, you have to decide based on what the investor's risk appetite is. There are products across, as I mentioned earlier, every segment of the curve today is giving you value. Just to give number, 1 year FMPs, something that we did recently, we were able to have a gross portfolio yield slightly above 7.5. And that's where the 1 year CDs are being offered today, or being traded. So that's a perspective. So if the client is very risk averse, he does not want to take interest rate risk, you can invest in the 1 year product, which is probably going to give you around that. If you are okay with interest rate risk, as we mentioned earlier, actively managed dynamic or government security funds are there. If the client is looking at predictability in terms of return, but is okay with taking a little bit of tenor risk, then you have all these target maturity funds. So the whole bouquet of products are there. Fixed income, as I said, as an asset class, is very, very clearly getting attractive today. It wasn't attractive 6 months back. it was clearly a no-go 1 year, 6 months back. But today, I mean, entire gamut of products, there are opportunities, and depending on the client's appetite of risk and tenor restriction, you could take that call.
Sir, you're telling that 1 year product means exactly which product? And secondly, can I tell them to invest in G-Tech or Gilt as you suggested? Maybe for 1 year. They are already holding for more than 2 years in savings fund.
No, sir.
So,
No.
1 year or so.
No.
Can they invest in G-Sec or Gilt or any other fund?
No,
or
clearly no.
Even dynamic bond fund or income fund also they will be ready for 2 to 3 years.
No. 1 year, then effectively you are taking an active punt on rates. Unless a client is okay with taking that call, or you are able to advise that, you should take that. So I would say 1 year investment. Why would you want to buy a GSEC or a dynamic bond fund, which needs to be held for at least 3 years? I mean, 1 year we are very clearly seeing potential for rates to top off and at some point come down. But the tenor, I mean, it's not, unless the client is actively monitoring markets, you're able to move in, move out at the right time. A 1 year tenor, you can very clearly stay invested in the same product, because a savings fund, which is a money market product, will take advantage of the higher interest which are available in the 1 year space. So as I said today, the 1 year T-bill is 7%. The 1 year CD is upwards of 7.5%. The carry on the 1 year product is very, very good. So that's the answer to it.
So which product I should suggest for 1 year? 1 year, 1 or 2 years? They are having 16 to 17 CRs presently. They were earlier having 36 to 40 CRs.
So sir, if you are investing only for 1 year, if the client's investment tenor is only 1 year, you should stay with the 1 year products, maybe the savings fund itself, or maybe low duration.
So if you continue to stay in the savings fund, after 1 year, you'll get indexation benefits also. So you could just continue holding on to that investment.
Oh, okay, sir. Thanks a lot. God bless you, sir.
Thank you.
Season's greetings.
Sandeep, you're
Sandeep,
muted.
you're on mute.
You're muted.
Let's take a last question, guys. So there is this question from Mr. Dheeraj Patwari. How wise it will be to shift existing investment in NHAI tax-free bonds with yield of 5.75 maturing in 2032 to GSECs through mutual fund route?
I don't know.
So the NHI is at 5.75, right? And assuming the current interest rates and assuming indexation benefits, through the mutual fund route, you could get about 6.5 to 7%. So that's the only benefit that I see. Of course, from a risk perspective, even NHI is safe, and we're going to buy into sovereign. So I don't think there's much of a difference.
So I think thank you so much. We have had a very, very long session. There are still so many pending questions. So in the chat box, I have requested that please put in your questions to your respective RMs, or I have given an email ID where you can write to us. If I really have to conclude this session, still we have around 800 people with us. Why we did this session? What is that MFT community, they do not sell that much of debt, especially in tier 2, tier 3 cities. And the reasons are maybe many. The reason can be the margins are very less in this product. The reason can be that not many people, understand the dynamics of the debt market. But why we have come out with this kind of a session at this point in time? Because we strongly believe this is an apt time to get more and more investors into mutual funds. So today, if you really look at the fixed deposit market, it's a huge opportunity which is lying in front of us. And with debt products, the YTM which are there as on date, especially the target maturity funds, you can definitely move that money from fixed deposits into mutual fund. Ultimately, we have to understand there is a tax efficiency in a mutual fund. There is very, very transparency, and the products that we are suggesting today have hardly any credit risk, as was discussed by our panelists. So we will once again request you, please consult your relationship manager, please talk to our branch officers, and they will be able to help you in convincing yourself as well as your clients to start taking exposure into debt mutual funds also. You have been such a big support. So we are very happy to share we are the first AMC which has been able to break that barrier of 17% market share in the industry. We today are sitting at 7,16,000 crores of assets. We today manage more than 5 lakh crores of only equity assets, and that has all been possible because of your support to us. So kindly continue with your support. In addition to equity, the kind of support that you are giving us in equity fund, please look at SBI mutual fund debt products also, because we believe if you will bring in new investors into debt funds today, you will be able to create more happy investors. So thank you very much once again for joining us. Thank you, Rajiv. Thank you, Dinesh. Thank you, DP sir, for joining. We can conclude the call now.
Thank
Thank
you.
you.
Bye-bye.
Bye.